Assalamualaikum warahmatullahi wabarakatuh. I am Intan Shahirah Binti Hamzah and my ID number 2022991075. Bachelor student from JPA 243E. Today, I would like to present my very first individual assignment of Advanced Corporate Finance with the topic of capital structure. And this video is prepared for Dr. Maizura Binti Maizura. So let's begin. Maybe a few of us are used with words of capital structure, but do you ever know what the concept of capital structure is? Capital structure is common among the corporate men, where it is primarily concerned with how the firm splits their cash into two different major components, which are fixed components that intended to pay debt capital commitments and residual components earmarked for the equity owners. In other words, debt and equity. Okay, next. What does it mean by the capital structure? A company's capital structure refers to the mix of the company's capital, which is the combination of debt and equity to finance its overall operation and growth. The company's capital structure may include a variety of components like ordinary stocks, various classes of preferred stock, bonds, debt with different maturity dates and retained earnings. Each of them is detailed in the balance sheets of the company. How about the optimal capital structure? To understand the capital structure better, first, we will go through the concept. Optimal capital structure is a point where the debt and equity are balanced to form a proportional relationship in maximizing a firm's wealth and minimizing the cost of capital. In determining the optimal capital structure, the firm must take into consideration of WACC, cost of equity, and also cost of debt. WACC is the best component used due to its direct impact from the financing decision. As the firm changes its capital structure, which is the mixture of debt and equity, it will directly change the WACC. Note that low in WACC resulted in high company's market value, and this will increase the shareholder wealth. Therefore, optimal capital structure is about to find the lowest point of WACC, because the lower the WACC means that the firm can maximize the firm's value together with the shareholders' wealth. Talking about the capital structure, there must be some factors that affect it and also the decision. So here are 5 factors that I will explain further. First of all, conditions of the capital market. There are 2 conditions of the market, which are a booming economy and also the depression. During booming, investors are preferring to invest in equity shares to earn more dividend, while during depression, investors become more careful in dealings due to the risk. The firm is advising to issue borrowed fund securities as it is less risky and ensures fixed repayment. Second, government policy. One of the most important factors needs to be considered due to its relation to base lending rate, monetary policy, and also the fiscal policy. If there is any movement in the lending rate, it will affect the cost of borrowing. Third, the cost of floating. The cost that included when the firm issued shares or any debentures. These costs included the cost of advertisement, underwriting, and etc. The cost of floating equity is much higher than floating debt. This influences the manager to take debt financing, the cheaper option. Fourth, risk consideration. If a company's business risk is minimal, it may obtain more capital by issuing debt securities, whereas a company with significant business risk should rely on equity. And lastly, cash flow position. The capital decision also relies upon the ability of the firm to generate more cash flow to pay off interest rate to the debenture holders, dividend to shareholders, and interest and principal of loan. The expectation of the cash flow must meet the obligation of payments, because if the firm fails to do so, it may face insolvency due to the failure of making fixed payments. Everyone must be used with the word of deferred payment, isn't it? However, how is it related to the financial distress? Financial distress is a condition that occurs when there is any default payment made by the firm. It is where the firm is unable to pay its creditors and lenders, and often in default payment can lead the firm to bankruptcy. There are 2 types of costs of financial distress, which are direct and also indirect costs that are associated with either the firm going to bankrupt or experiencing the financial distress. Direct bankruptcy is a cause when the company files for the bankruptcy, and there are various legal and administrative costs included. On the other hand, indirect bankruptcy cost is where the assets start to lose value as the management tries to avoid the bankruptcy. The stockholders want to avoid a formal bankruptcy, while the bondholders want to keep existing assets so that they can at least receive the money. There is a trade-off between the tax advantage of debt and the cost of financial distress. Based on the Modigliani and Miller theory, argue that there is a relationship between the value of the firm and the debt. Add on, in this theory, the firm's value increases with the leverage when there is tax. Based on the figure 1, VU is the value of the firm without debt. VL is the value of the firm under the Modigliani and Miller theory with corporate tax and debt. The difference between the VL and VU is the present of tax sheet on debt, while the difference between VU and V is the present value of the financial distress cost. Increasing this value will decrease the value of the firm. We move to the next slide. The main idea of agency cost is a conflict between principal and agent. However, in agency cost of equity, it is a conflict between the shareholders and the managers of the firm. This conflict arises due to the shareholders wanting the manager to take decisions that will benefit their side. This includes increasing the value of the dividend paid to shareholders. However, on the other side, the managers are willing to take decisions that will benefit them or expand the business. When the management diverges from the interests of the shareholders for any reason, the shareholders have to bear the cost. It is a cost involved to keep a check on the management decisions making by the shareholders. The higher the firm paid to the shareholders, it will decrease the value the firm should use for reinvestment in order to expand the business. What is really the backing order? Backing order theory is a method of financing. It is where the way company managers decide to finance company activities based on the hierarchy. It starts with using either retained earnings or debt or equity. Retained earnings or internal financing are the first in the hierarchy because there is no other related cost that arises when using it. So the firm will not be tied to pay any cost like cost of debt or any cost of equity when using their own retained earnings. However, if the retained earnings are unavailable, the firm needs to move to the second level in hierarchy. Second level of backing order theory hierarchy is debt. It is associated with the use of debt capital. Some interest need to be paid by the firm, either to take out business loans or issue any bonds. Compared to equity, cost of debt is way cheaper due to the tax deductibility. Last but not least, the equity. This method of financing will be the last choice for the firm due to the highest cost compared to retained earnings and cost of debt. But this method of financing is not risky. It is 100% dependent on the people to become the shareholder of the firm. The firm has no obligation to pay the shareholders their dividend. We have reached the last slide, where we will discuss the signaling hypothesis. Signaling hypothesis is when both manager and shareholders have the same information, which is called systematic information. However, practically managers will know better than shareholders in terms of managing the company, and this is called asymmetric information. If the managers believe that their firm is undervalued, then they will issue debt along with the equity as a last resort for the firm. In contrast, if the managers believe that the firm is overvalued, then equity will be issued. If the managers do have inside information, their decision on capital structure will signal information to the market. And that's all from me. I hope you understand all the information I've been giving out. Thank you. Till we meet again.